I'm Russ Mould, AJ Bell's Investment Director. With me is Richard Penny, Manager of Legal & General UK Alfa Trust and also a Special Situations Fund. Now, Richard's funds cover the full range of UK companies, big to small, but I think it's fair to say you're probably known for your small cap expertise. Now, at AJ Bell Youinvest, we know a lot of you would rather actually pick your own stocks rather than pay somebody like Richard to do it for you with a fund. So he's kindly come in today to talk to us about small cap investing, and particularly on this occasion, the dangers. What can go wrong and how you can try and avoid them when building your portfolio. So Richard, one plain speaking northerner to another, what can and perhaps does go wrong with small caps?
Yeah, if you invest very early, there is a subset of the AIM market that are early stage businesses. So
that's no profits, maybe even no revenues?
Yeah, they can be either of those. Right. They come in all shapes and sizes. There is a tendency for these businesses, maybe not through their own problems, to not deliver on the expectations that are there, and quite often that can mean they run out of money. So I would say a big thing that I would consider is invest in some of these sort of really high upside businesses later on. You want to see a business that not only has a good technology but a well-developed product, but that can also sell it. You know, if you invest in a business, you don't know whether they can recruit the right kind of salespeople. You don't know whether they're going to generate the cash, and you don't know whether you're going to get a good upside in the investment. So sometimes it's better to invest slightly later. Maybe you might pay 100% more than the first time you see it. That sounds ridiculous, but I'm really telling you that you would probably avoid 7 or 8 other investments that you would invest earlier, and they would just
could potentially run out of money.
They come to very little, and they can run out of money. I mean, that's very specific to some of the early stage AIM markets. I would also say some of these overseas companies at the very low end of the market.
Now, is that a governance thing? Is it a language thing? Is it a cultural thing? Or is it what do you think the issues there are?
From my point of view, it's very difficult to go and
visit them and actually find out what's there.
You can get on a plane and go to Malaysia or India or China, but you can't do it very often. And it's more difficult for them to come and see you. And also, in terms of sort of contacts that you might have that might know something about the business, it's more difficult to find those as well, because we don't.
So it's harder for you to do your own research, effectively, which is obviously what you preached with regard when we first started talking.
It is, and there's a culturally different way of doing things.
Dealing with shareholders, for example.
Yeah, I mean, even Americans is slightly different, but I mean, Americans, sometimes you get American companies in the UK small cap space. They're okay, as are the Northern Europeans. And everybody else is okay, but they do things differently. You have to understand it, and you have to take the time to do that.
So I'm saying you've obviously, again, do your own research is a big message. Look at the products, the business model. Do you trust the management? Does it have the cash? It's clearly a big one. So
and then what you pay for it, Russ?
Well, that's the next question. It's clearly, we can probably all spot a pretty strong story, but what about valuation? Because a good company can still be a bad investment if you pay the wrong price, I guess.
Yeah, I mean, if you pay a high PE multiple or a high multiple of profits, then you might have to own a business for a long period of time.
For it to grow into that sort of...
For it to grow into it. And the flip side of that is sometimes badly performing businesses, everybody's sold out of them, and the price becomes so low that you make really good money on it on a recovery type investing basis.
Okay, and so just to give us a little bit of a flavouring, without giving anything that could be misconstrued as financial advice, we're going to put you on the spot now and ask for something that's gone wrong in one of your portfolios and what lessons perhaps you and our customers could draw from that.
Yeah, I mean, one of the stocks I did badly on is a stock called Korak, which was, it was developing a technology with massive upside for the oil and gas industry.
And it was run by a pretty smart guy as well. It was success at a previous firm.
It was run by a professor.
Yeah.
But professors are good at developing technologies, not necessarily doing the commercial bits within the business. Right. And that's one of the reasons why I would say now that I wouldn't tend to get involved with these businesses when they're too early. You want to see them when you know that they can make reasonable sales. As it happens, that business has changed its name and it's now got profitable businesses, and actually it's a share I possibly would get involved with. But if you invest in businesses too early, it can be a painful, drawn-out experience.
Thank you very much, Richard. That was very helpful, and thank you for watching, and we look forward to seeing you another time.
Thank you.